Hi, everyone. Thanks for joining us for this workshop series. It's part of our Startup Investor Accelerator program that's sort of a precursor to our Transatlantic Angel Conference, where we try to get new angel investors and new startups to run into each other. And today we're going to talk a little bit about what the trends in angel investing are over the last little bit. We've had a lot of changes in the ecosystem over the last couple of years, and we're sort of expecting a lot of changes in the economy over the next couple of years. So we're going to sort of dive into that a little bit. Just as an introduction to myself, I am the founder of the Seattle Angel Conference that we've been running for a decade now. We just started round 22, which happened last night. Have 86 companies and 25 investors in the program, and we'll go through the program. In the end, a bunch of people who were not angels yesterday will be angels at the end of December. And we're going to do the same thing now as we expand to Europe. We're going to do that with the Transatlantic program that we're working. But today we have two people who have been looking at the European market a little bit stronger than we have. And we're going to talk a little bit about what angel investing shifts are happening in the ecosystem a little bit. Helena, could you introduce yourself and tell us a little bit about your background?
Sure. First of all, thank you so much for having me tonight for Barcelona and early morning for West Coast in San Francisco, where I'm based. My background is in operational scalability of startups. I co-founded two companies and scaled both of them from 3 people to 300 people, and eventual acquisition of one of them, and working on scalability of the other company later on. I run a super early stage accelerator focused on cybersecurity, and right now I'm running portfolio development for Munich Ventures for cybersecurity and health tech verticals. I also been involved as advisor and angel investor in a couple of startups myself, and worked on multiple accelerators and incubators as invited expert mentor on matters of fundraising, early stage development, and scalability of startups. So happy to discuss what current environment is all about, what kind of trends we can see, what is the difference between US investment, Western Europe, Eastern Europe, and all over the place.
Great. It's really great to have you here. Tuomas, could I get you to introduce yourself, please?
Thanks. Likewise, great to be here sharing my thoughts. So my background is also as an entrepreneur. I founded a couple of companies, data analytics and sensors, different type of deep tech stuff, and scaled them quite big. The other one went to 400 people, and the other one was something like 40 people out. Sold them both in the other one in 2014 and the other one in 2017, and since then wanting to give back for the startups and coming as an angel investor to help the startups as well, and a little bit also kind of looking my life for the past 5 years, what else to do in the life than the startup world. But I would say been there mostly with the kiddies the past 5 years, but now it starts to go back to that I need to do something else than also staying with the kiddies. So I've been investing now for 40 companies roughly in the past 5 years, and also board member in FiBAN, and the final kind of new adventure I'm doing at the moment is actually a portfolio management tool for angels. So we just launched in the spring, started to use basically a tool where you can manage your investments as an angel investor, making it much more simpler than these VC routes. And this is something that we're working currently. And John, you're muted this time.
Thank you. That was so you didn't hear all of my typing. Thank you for that. So we see ourselves as sort of being the very first step as someone who can be an angel investor but hasn't yet started to start their journey, but also for startups that are very early to sort of get their data room together and get their story together and to get clarified. So we're very, very early. We might even say pre-seed is the stage for us. That's not quite true. We gather somewhere between 100,000 and 200,000 to invest in a company, and then go through the due diligence to make sure that we're doing a reasonable deal. you said that you were in 40 deals over the last 5 years, which is a little bit fast, but it's the right number that we expect our investors to accumulate in their portfolio. So angel investing onesie twosie is like a really bad idea. It's better to go to the casino than it is to angel invest in 1 or 2 companies. But getting to 20 or 40 companies, now you get to the point where your portfolio might have some stability to it and make it go. But we've had a lot of uncertainty in the ecosystem. I wonder if over the last couple of years, if there's anything that sort of stood out to you as things that are different now than they were like pre-COVID, or different now than they were when we were in lockdown, or just things that are highlighting the differences between what you did before and what you're doing now. Helena, would you like to lead off?
Oh yeah, absolutely. Couple of things. First of all, is how the deal flow started. Initially, pre-COVID, it was firstly in-person interaction. Right now, it's online first, and any kind of offline interaction right now is just to verify, oh, I've seen you over Zoom for so many years. Is you're actually a decent person? And sometimes it's extremely surprising to see how different this human-to-human interaction can be. The other thing is, for the same reason, the deal flow, both for investors and for startups, became easier thing, because previously you needed to be in special location like Silicon Valley, New York, London, Berlin to have access to a particular type of resources. Right now, it's much easier because you don't have an expectation of in-person meeting. So it became much easier to raise for companies from this perspective. It's still not that easy to have an access to good quality of expertise and good quality of capital, but just an idea that you don't have this in-person component is easier right now. The third thing to mention is this hybrid format enabled beautiful, diverse teams spread all over the world, like all of us today, right? And you also have teams like this. And I do believe that teams with this global perspective can build much better products because they're not focused on particular niche problem. They're trying to solve issues that is very international. So having this kind of setup adds a lot to market development in general.
John, we got you on mute again.
Bad habit. I noticed that as I go to Portugal or Spain or Estonia, that the first things out of people's mouths are, we're just a small country, but and they go off and chase something about their local ecosystem in the conversation. And if you look at the state where I'm at, we have like a little more than 6 million people in the whole state. And so we're like one of the small Nordic countries, but we don't lead with we're a small country, right? And we have a very narrow perspective of trying to talk to the US and can't figure out anything outside the US, where all of the countries that I talk to in Europe sort of start with we have to be international from the very beginning of the company. And so there's a fundamental difference in there that I think that you are highlighting that's sort of important, is to think about where the company's going and how that's going to go. Tuomas, can you talk a little bit about what you see being different over the last couple of years?
Well, I agree a lot with what Helena said, but I think the other thing that, well, let's put it this way, that if we take 2 years chunks on angel investing, I think every 2 years the whole industry has been changing. So if we go to 2010, 2015, so forth, it has been changing many times. And one of the things, I started in 2017 investing, and it was very different than 2020. So actually, when we started to see the valuation going up, and the more we start to look at actually data, was that the angels was not getting into that whole valuation game that much than the VCs were going. So actually, the first thing that happened was that angels, I think we were trying to kind of still have the kind of visibility of what's behind the valuation in the early stages, trying to rationalize it. So we were not willing to go to that game. Thus, that meant that angels were not doing that much of deals during the start of the pandemic. Now they start to get actually back to the game more and more because the valuations are coming down. So I think that's one of the things kind of what's driving. maybe the other thing actually the notes from the statistics is that although it's still kind of the we have our investing or the overall venture capital market is doing more money in than before pandemic, it's still the deal size is going up, or it's still going up, but the amount of deals is flat throughout. So what that means for startups is actually that it's not easier to get money, although there's more money, but you have to get more money and you have to be able to deploy more money. So you have everybody's looking for the bigger and bigger kind of cases, and being even a unicorn starts to be kind of smallish for many of these VCs. So I think this has been creating kind of a smaller market actually for angels, which are okay to go with the smaller tickets, and we're okay with 100 million or 500 million exits. So we're not that, or there's kind of room there to invest in the smaller companies and smaller exits. So I think that's kind of evolving completely different market again.
So I noticed that in the Seattle context, we have 9 angel groups that have a public website that sort of, wave their hands and say, we're angel investor groups. In Finland, there's like 1, right? You have FiBAN and everything is FiBAN and over everything. But I noticed that from like 2015 to 2020, there's sort of this, there's sort of the first pre-seed investment, and then there's a seed investment, and then there's your Series A. And then now when we look in 2020 to 2022 or so, the number of sort of second seed investments has gone up dramatically. And so the distance between that seed investment that was the real mature angel groups investing in your company and the first institutional money, there's sort of like a double step in there now. Are you seeing that happening in Europe as well?
Definitely, I would say that it's the bridge rounds. That's kind of the norm, that your extensions over extensions.
I see the same kind of trend going on, and this actually opens an opportunity for multiple angel investors to jump in and deals that would be not available for them earlier before, for a couple of reasons. We've seen a major boom in valuation in 2021, and companies that are raised successfully in 2021 right now are afraid of recession, market downturn, bear market, and multiple other factors that are impacting market dynamics. So they're trying to look for potential ways to extend the run rate. And this like bridge rounds and seed extensions are a great way for angel investors to jump into the process as well. So the other thing which I believe is more important is that general market downturn is a great opportunity for angel investors to familiarize themselves as an industry, because previously the checks that average angel operates would be relevant or only for like super early stage company. Right now, this check makes difference on much later stages, and you have much better company with much lower valuation because of market downturn and general availability of capital. The third factor is that multiple venture capital firms on a current market stage, they're just not going for not a price round for obvious reasons. Dynamics is questionable. LPs just not that interested, and there's like multiple other factors inside. So is this not willingness to jump into not a price round, and availability of not price rounds for angel investors creates like much better economic opportunity in general.
Tuomas, any thoughts about that?
Yeah, I agree that this kind of secondary market, there's actually funds coming into this secondary market, but they're opening up also for angels. So it's kind of new opportunities to get into kind of a little bit more stable, a stable part of the game. So meaning that there is actually numbers behind the startups often already, and much more traction, much more proof behind the idea. And these are the type of things that typically weren't available for angels 2-3 years ago.
And how do you see the deal terms or the valuations changing between that first seed and second seed or seed extension? How is that, how are the first angels succeeding with their deal in a way that is different than or the same as the second round of investment in that seed extension? Are they the same terms, or are the terms changing?
Well, if I'll take my take, I think actually it's very much market driven. So meaning that when we look at the Finnish market versus the Baltic market or Estonian market, Swedish market, they all have different terms. So I think in Finland, we start with lower valuations, lower pots very clearly. And there's kind of still this mentality that you expect to do a lot with a small amount at first. So that's kind of what happens in Finland. And then again, that leads into the situation that there's kind of no room to go down. But while we go to Estonia, the kind of the Baltics, the valuations has been going like the US companies has been going up for a long time. So I think you can price the same type of companies 2-3x in the Baltics versus in the other Nordic countries. But then again, the bridge rounds are much harsher there because you have the room to go down if you're not succeeding with the original investment. So I think this has a kind of impact coming down. Of course, then there's kind of the issue with, especially there's a lot of new VC funds in the Baltic area, some in Finland, but I say Baltic areas where they are mostly coming in, and they tend to have a kind of need to protect their first investments. So they don't want to go to the down rounds. It's kind of looking bad for their returns there, especially if they're new funds. So there's kind of protection level as well from the existing investors.
Helena?
Couple of things. Firstly, the dynamics when it comes to bridge round, I would totally agree with Tuomas. It's exactly the way it is. The dynamics is different, really depending on the region, for a couple of reasons. First one is an access to the capital. If you do have a robust, experienced market with experienced investors, the fluctuation when the market is going down or market is growing is a normal thing, and it's not that dramatically impacting valuation. But when you have first comers or when you have like emerging market and dynamics is different, obviously access to capital would be different. The other thing to consider is origin of capital. If you're a European startup and you worked with US investors and you're aiming for US market, and you have different type of like portfolio and valuation, and your numbers are just different, then for you coming to European angels and raising a bridge would not be the best idea, because your valuation would like fall down 5 to 3 times. So it really depends where you raised your initial capital, and this impact in terms significantly as well.
Sorry about that. Yeah, so we noticed, we raise for our program somewhere between $100,000 and $200,000, but we take applications from anywhere in North America or in greater Europe. So when we have a company that applies from Armenia that might use that $100,000 investment, the structure of that company, the valuation of that company, the stage of that company are fundamentally different than the German company that's coming in looking for that $100,000. Can you talk a little bit about the breadth of contexts in the European market and how that might be different than what you see in the US market, especially the Bay Area market?
So couple of things, and I'm Ukrainian by background, and every time I tell people that I'm involved in a couple of companies that still have an operations offices and resources back in Ukraine, and when I tell us that, by the way, they've been able to fundraise and launch sales and multiply their revenue by 10 times, like, how? You have like war going on? I'm like, yes. And by the way, despite having war going on and lower valuations, you have this habit of operating with lower resources. Therefore, your not valuation is skyrocketing in general because you're raising steadily. You're not raising big amount of money. You don't have a dynamics of raising once per 9 months to a year. You're raising once per 2 years in general, which is completely in contrast, for example, UK market or US, where you expected not to be profitable and raise every 6 to 9 months. Therefore, this difference in general patterns of how companies are developing. There's pros and cons, because in especially on the West Coast, you're expected to raise a lot of capital and you expect to burn a lot of capital. You're not always expected to deliver on it. In Eastern Europe and in Europe in general, you expect to have some kind of performance, some kind of validation, and after this race. Therefore, just like a difference in approach. At the same time, I do believe that European angel investors are well positioned because they can leverage both. They can leverage access to Western capital when it comes to institutional investors, angel groups that are more mature, and at the same time jump in on much lower valuation. Because you have great companies working on great products. At the same time, they don't have this overhyped valuations, and they're not that hype driven. They're more hypothesis validation driven, other than just a hype on the market.
Yeah, so I think that, someone at the beginning asked me if I was going to the TechCrunch thing in the Bay Area. And I think the difference you just described is the difference between Seattle and the Bay Area. Seattle angels prefer that you have a real business at the core and that there's real execution at the core. And, if you have a good story, great, that's nice, but not necessary. What's necessary is that you're operating on a business at the core. And that difference between the willingness to try something and be unprofitable for many years versus the willingness to build a real company and then understand where your revenue comes from, those are fundamentally different worldviews. Is that also what you see in Finland, Tuomas?
Definitely, I would say. I think overall, if we compare the European versus US market, I think there's a lot of kind of memes out there, but very often that if we go to the VC memes, the European VCs are asking for the financials, give me the numbers, give me the number. They're really metrics driven, while I have been in many meetings and nobody asks anything about the product and doesn't call the customers or so forth, while the US is actually focused a lot about the product or the story behind and so forth.
Right.
And I would say the Nordics and Baltics, it's really heavily focused on the execution, and especially I would say the big part here is that I wouldn't even call Finland a country, but we call it a country club. So it's kind of really small area, and if we're able to get some traction here, it's never enough. And it's actually easy to get traction here because this is not the market where the competition comes easily. So actually, when we know this, and it's hard to get out from here, so that's where we put a lot of emphasis. This is that you're able to tell the story locally, but that's kind of leading nowhere. So meaning that we're expecting that you can also show the international traction as soon as possible. So are you actually up to that game?
Yeah. So Antonio in the chat asks whether this is true, what you were saying, Helena, about all sectors. Is it true in all sectors that there's this sort of foundational perspective versus the hype perspective?
I do believe that this approach is just different when it comes to different sector. When we talk about like approach in general, it's just a market trend, but it really depends on, for example, when you talking about like crypto products, for example, or crypto projects, it's going to be different because the ecosystem just operates and Web3 just operates differently. So this approach won't be thus applicable because it's just like its own sync, and the market dynamics is different, yet still impacted by US approach on one end. When we talk about hardware, for example, it's going to be completely different because in hardware you need to have more capital intense R&D process, and everyone is still expecting to have something going on. When you talk about anything connected, for example, to cybersecurity, which is my core industry, cybersecurity and health stack, and we still focus on product more in US. Back in Europe, because I've been running an accelerator back in Europe, it's different. You're expecting to have commercial validation. Here in US, you're expecting to have a product first. When it comes to health stack, because health stack is such a hard market to scale, and in US you have the same approach. And if you're able to launch a product in one state, you're going to be able to scale it in different states. Because of regulation in Europe, for example, for health stack, it's different because you won't be able to sell the same type of technology in Germany and in Poland. You're going to need to comply with different type of regulation. The products in health stack in US going to be market driven and metrics driven more.
So your organization invests in cybersecurity and in health and in climate tech, and so it like really weird combination of, we do hardware here, we do medical there, we do software here, we do Web3 there. How do those differ between those sectors? And then how does that taste between the two? Is there anything that stands out for you about sort of like you have to change your brain as you move from one sector to the other for that?
I do believe that thesis-driven institutional investors are the one who are the most diligent about their deals. That's my personal opinion. So as a fund, we are extremely thesis-driven. So you have different people who are in charge of different verticals. And for angel investors, when people ask me my recommendation or reference, start with industries that you know, because there's, especially when it's been a bullish market for crypto, it's been a thing where people with no expertise in blockchain or crypto industry or technological background of crypto industry, let's put all the cash into crypto market without knowing what's going on over there. It's been exactly the same with ad tech and advertising before, right? So if you do have real estate experience, beautiful. There's multiple of prop tech companies, there are multiple real estate tech companies, there are multiple products around your industry. And having your own expertise and your own background connected to the product is extremely important. The other thing is expertise of people who are running it. You may not be the most knowledgeable and skillful person, but you definitely, if there's the founders whom you talk to, you can definitely believe in their expertise. It's much better investment decision than it's a beautiful product and it's a hyped up thing right now, because hype is coming and going, but people are staying. So those like factors are more important. Thesis and expertise are more important than anything else when it comes to industry specification.
Yeah, that makes sense. When I was in, go ahead, Thomas.
Yeah, if I may actually just to comment on that regarding angel investing and the typical investing, what we learn about investing into stocks is that it's really hard to beat the index in the stock market. So actually selecting stocks, that's kind of more luck than and actually that you can do it. But the startup world is different. Here you're actually, what you select is the matter. So you have, most of the startups will not make it. It's actually screening the bad ones out. So it's not that much of that, can you instantly find the winner? That's why you need the portfolio, maybe 20, 30 companies that the winner will be one of those. But what you need to do is to at least be able to select those ones out that will not be the winners. So it's really much about selection and selecting or filtering out the bad ones.
Absolutely. And not only is that a story, but we have data on that. So the Oregon Angel Conferences that started in 2002 had a decade or so of data, and they looked at all of the companies that came through their program, and they discovered that the companies that didn't make it to the finals versus the ones that made it to the finals, there was a statistically different success rate. But of the ones that were in the finals versus the one that got picked by the Angels, there was no statistical difference. And so out of almost a dozen years of data, we come down to that, right? There's a PhD thesis on that very question. And so we know that we can pick things about companies that are fatal for the companies, that make them unlikely to succeed. And we are not very good at selecting the factors that will make a company succeed in this uncertain space that we're in, which is why we need the portfolios. How big of a portfolio do you expect to accumulate, Tuomas?
Well, actually, I'm starting to slow down now the direct investment, so I'm investing more through funds, just merely because of I got into the game of wanting to help, but frankly, do I help the startups anymore? Do I have time for them? So it's kind of, I'm losing a little bit that part of the game now that I'm not able to help them. So I think maybe it will double over the years, but more about the VC funds at the moment.
Right. And so one of the things that we see is that people get overly enthusiastic at the beginning, and then they write a lot of checks, and maybe they write a lot of bigger checks than they should be writing. And then they have some infant mortality that comes along, and then they slow down a little bit, and then they get to the point where, oh my goodness, I've got 40. How do I even pay attention to 40? And then they go. We have some super angels in Seattle that are well up past 200 investments. And I go, like, how do you do 200 investments? And the secret is that they've hired someone to manage that, and they don't think about it, right? So most angels aren't going to do that, and they need to be a little bit more sensible about things. Yeah, so Dina, did we answer your question about hardware kinds of things? Your question was—
yes, thank you so much.
Yeah.
Yes, thank you.
Okay, so it capital intensive stuff takes a lot of money.
I run as chief operating officer a hardware company. At the same time, I do see a lot of hardware companies on a front line. Dynamics, valuation, market potential of hardware companies completely different from software. So please don't use metrics applicable for software companies in general for hardware companies. R&D cycle, resources, manufacturing, certification, safety, logistics, all of it. You can get big market share, and there's like huge potential in hardware products and robotics in general, but just please don't use software metrics, especially hyped ones when it comes to hardware. You're going to feel extremely sorry for yourself. Your investors won't understand what's going on, and it's not going to be a good show moving forward. Understand that there's a lot of market nuances when it comes to hardware, and operate accordingly.
So we have in Corvallis a company that is NuScale, which is a nuclear plant company that builds little tiny nuclear plants that you can plop in the ground. And they took a seed round of $50 million, and they took another 8 to 10 years to get to the point where they got certification. They're just getting certification now where they can just now do sales, which is a fundamentally different world than even the hardware world, right? And so you have to understand what the constraints on the market are for that thing. The fact that they had something interesting, that there were investors that cared about seeing it happen, is what enabled a $50 million seed round, right? So they had the relationships with the people that cared about that market. And that's true of every market, is that you have to find the investors that match the market to make that go. Which also means that you as an investor can't be randomly picking companies in random markets. Yeah. Are there other questions? We have a hard stop for Helena at 10. And so are there other questions people want to ask from the audience? Yeah, Asma.
Hey guys, how are you? Thomas, you mentioned about in Europe, when you're going to the angel investor, they are checking the numbers. And normally we are going to the angel investors when we are in a pre-seed situation. So our number is not that much big. It's like, oh, we have a 160 shops and we have a 10, I don't know, subscribe users. So this numbers, we know it's not make sense at all. But we are in a pre-seed situation as well. So what number is good enough to go into an angel investor? Because it's like a egg and chicken situation. You need money to advertise more to get more traction, and without traction you cannot go and get more get investor.
It's definitely not a chicken and egg problem, so be aware of that. There's some magic in this that's worth understanding. Thomas, do you have a thought on the question?
Well, I think, John, you can answer that if you want.
Oh, I have just tons of opinion about this. The question, the first question is, do you understand your sales funnel? And so if you don't have a sales funnel built and you're looking at your Facebook or Instagram metrics and you're calling those metrics, then you haven't built your sales funnel. So you need to understand your sales funnel. And understanding your sales funnel means that you run people through it one at a time until it works, right? And you don't hit the scale button until your conversions look good on your sales funnel all the way down through the sales funnel, right? This is the R, Pirates metric: acquisition, activation, retention, referral, and revenue. And so if you do not have 20 fanatical fans that love your story, that can't shut up about you, you're not yet ready for the hit the accelerate button. And angels are the accelerate button. And so all of that work before the accelerate button is building your sales funnel and understanding it. And I saw someone, Arthur, put in dollars per month and split by country, good reporting, blah, blah, blah. I'm looking for traction. Traction is of customers. Customers are people that pay you. So I'm looking at revenue. But what I care about is that you are on an exponential growth path, which means that I'm looking for week over week growth of 3 to 5%. If you have week over week growth in the number of people paying you, that's 3 to 5%, you can have, 100 customers that are doing that and have this growth rate. And that turns out to be a 10x year, right? By the time you get to Series A, you need to be a 3x year, because it's very easy to be 10x in the beginning, but it's really hard to be 3x at the end. And so just have to work it step by step. So how many customers paid you? 0. Okay, then your goal is to get 1. How many people get, then you get 10, go from 1 to 10, go from 10 to 100. That's all by hand, right? Go from 100 to 1,000. Now you better understand your submarkets enough that you can find where your conversion rates are high, so that you can focus on that. So you can say to the investors, look, if we put this amount of money into this thing here, then we'll get this number of people, because our cost of customer acquisition is this, because we measured it. Now everything flows, and there's no chicken and egg in that.
I do believe that's exactly right approach, and investors are not looking for perfect numbers. They're looking for validated hypotheses. You need to have a validated hypothesis, and failed experiment is also a validation. Hey, if we tried to sell through Facebook or Instagram, it didn't work. We found 3 sales channel partners, and we have 2 contracts signed, and they will execute during 2 months. That's the reason why we need X, Y, and Z dollars to execute 2 contracts. Your actual value is 0, but you have validated hypothesis. And for B2B companies, validated hypothesis is always about third parties involved, channel partners, customers, potential partners in general. It's all about having third-party validation, because investors are validators, accelerators, and validators. So if you have third-party validators already, it's going to be much easier to build your communication, because, hey, we are validated by partners. Can we be validated by your capital, and vice versa?
Exactly, and this is actually the thing that why we started to build the portfolio monitoring tool for angels, because one of the things that my background is in analytics and measuring stuff. So what we wanted to build actually on the background of our tool is how to measure startup progress before you have numbers, because the only thing that actually is going to be coming with you all the time when you're growing a startup is that you're never ready. The next phase and do the next phase of solving stuff. So what we are actually looking at that when you get to the next problem, can you solve it? So what's kind of your clock speed of just chewing stuff down and doing the next thing and the next thing? And that's actually what we look very often on terms of traction, is that let's say one of my kind of taking an example of one of my kind of early mistakes of investing in a startup was investing in a kind of nice looking deck, good team, good presentation, kind of they had figured it out. And then when I went to the next meeting, I was already in love with it, but there was kind of no progress on that. And neither in the next one. And okay, the team is doing quite okay, but they're doing just okay. They're kind of junior team from the university, just out of the university, no real business experience. They need to learn everything. They're executing, but they still need to learn everything. So the trajectory is quite low, and out of an investment, it's not that good. While you can be much earlier, much not or figured out this stuff, but if you're able just to get your clock speed of figuring this stuff out and solving things, getting understanding the feedback coming from customers or channel partners and so forth, and solving those stuff, that will take you much higher. And that's typically what we look for, the best cases that comes into us, just that can the team take the feedback and iterate it on it and make kind of smart decisions forward? Because that's that type of thing that if you don't have that in the team, it's not going to come from the advisors or from outsiders. You just need to have that ability to execute in the team. And maybe related to this, John, if I may take actually one more point, coming back to your comment on the angel investment statistics or data that you had regarding the report. We did the same type of analytics out of FiBAN's investments throughout the past 10 years. And what we noticed actually on those was that the companies getting angel investments versus the companies that didn't get, they were growing in during 10 years period of time. The companies that got the investments, they were 20 times bigger in their balance sheets and 10 times bigger in the employment amount and so forth. So they were kind of really much higher grew up in 10 years than the ones that got. And when we were analyzing, we actually went through all of these cases that came into the FiBAN in the past 10 years. So there was kind of 2,500 startups that applied during 10 years. And we started to look at what's the fee and then started to analyze what was the actual output of why we accepted some. And out of this more than 2,000 companies, we realized that there's kind of repeating things that we noticed that the startups were missing. So it's kind of the repeating things that the customer problem is not defined, or the solution is actually not solving the customer's problem, or the market analysis is missing, or the market is small enough. And what we realized out of this is kind of, it's the same pattern that it's the same things that startups needs to always solve. And they're just repeating the same issues. And what we actually did in our kind of portfolio tool now, and what we are using FiBAN, but in many bonds in the Nordics and Angels, is that we use this analysis out of the startups, that what's the typical issues. And then we can give as a feedback as tags, kind of, for example, that this startup is market analysis missing here, or they don't have a competitive advantage. Then when we have these tags tagged to the startups, what we are actually doing there is just checking how fast the startups are fixing the issues. Because when we break down the feedback in a way that, okay, market analysis is missing, the best teams comes overnight, and here's the market analysis. While another team might take it 6 months, and doing a market analysis doesn't take you 6 months. So this is actually what we mean by traction, and can the team just basically take the feedback and have that trajectory of just taking stuff forward. But by the way, you can just go to our website of hopohopo.io and test it out. So there's kind of, when you get startups in, just test the evaluate button. So there's all the kind of tags that we typically see in the startup. So we created that actually for the reason that we can teach new angel investors kind of the typical things that we will notice and the typical things that you should evaluate out of startups.
So I put the link into the chat for your company so people can look at that. I see a note from Andrew saying, but you're angel investors, why are you talking about traction? So Helena, you want to take that question as your last question before you head out?
Yes, because traction is not about $1 billion on your bank account. If you have $1 billion in your bank account, you're coming for growth equity or public market. Angel needs a validation of hypothesis, and traction is not always about money, as we discussed before. It's about ability to make progress. It's about ability to have feedback. And for example, great example is like, hey, what are your channel partners? We don't have any. Would it be possible for you to have LOI or MOU or just an interest confirmed from somebody else in a month? And when you come in back in a month with like, hey, we have an interest from a third party, it's also attraction, because it's a validation we discussed previously. So traction is not about cash. Traction about ability to grow, receive feedback, and execute. Because as we've discussed today, there's beautiful markets that are coming and going, a lot of hype going on, but ability to execute and adapt is what makes companies great. And if we're talking about filters and factors, how to skip company that is just not worth investment is companies that is not able to receive feedback and execute on this feedback. Thank you so much for having me tonight. I unfortunately need to run. It was a great pleasure, extremely delightful conversation, great audience. My LinkedIn is in the group chat, and I'm pretty much easy to reach out. John and Astrid, thank you so much for inviting me. Tuomas, thank you for a beautiful discussion and great insights. Have a good one. Bye-bye.
Thank you so much. Bye-bye.
Thank you, Helena. Thank you so much for being here.
So I want to step into that a little bit. Helena suggested that traction is not revenue. And I, being a fanatic about lean startup, would press on that a little bit. So if we believe in the 4 steps to epiphany, which is Steve Blank's book from 2003, which is that customer development happens before product development, then we need to somehow find a group of people. So if we look at the lean canvas, we've got customer, problem, early adopters, existing alternatives. That's step 1, finding customer problem fit. Who are the early adopters that have the problem, that have customer problem fit, and what do they currently do? What are they happy with? Well, what's an early adopter? An early adopter is someone who has the problem, knows they have the problem, has spent money to solve the problem, is still unhappy, and is still willing to spend money to solve the problem. So what we're looking for is to qualify people as customers. What makes someone a customer? They're willing to spend money to solve the problem. So if you can't measure that, then you don't know that they're a customer. So you can run Zoom meetings, you can sell white papers, you can do tours, you can do a lot of things that you sell things that you have now before the product, which validates that they are people who are willing to spend money now to solve the problem. And if you do that for 100 or 1,000 people and you get that group of people, then when you do the hypothesis validation, you have a denominator by which you can do that. I take 100 people out of that group of people that I know are customers because I validated that they're customers, and then I offer them a solution, and then 30% of them say, yes, that's a solution, right? Or then 80%. Now I have 2 markets, right? This market's converting at 30%, this one's converting at 80%. Now I know something about the 2 sub-markets, and I can focus on what I need in my market because I know that they're customers willing to spend money today to solve the problem. If I don't do that work, then I'm standing on the street corner talking to random people and I have no denominator. What happens when I get a conversion rate of 2 people out of 7.9 billion? Still 0, right? I have no data. So we would like to understand some clarity on who the customer is at some level of detail. And if we can't see that in the conversation, then why are we investing again? How does that sound, Thomas?
Exactly. And I think exactly the point of how do you derive into a kind of paying customer, and are you actual? I'll put it actually what we're doing here in Finland very often. Where it's kind of to put it kind of the first testing that are you actually understanding even customer development. So I think that's kind of one of the big issues here is that how marketing works. So very often we see these people who wants to build product, and then they think that when they are building a product that they think is solving a problem. I don't know. So one of the things I very often as an angel investor have a hard time is to analyze, is there really this type of problem? I don't know very often the domains that well, or the especially when we go to technicals, or I don't know the competing environment that isn't there already a solution out there for this. So it's kind of hard to go into, or it's easy to tell a story that there's this type of thing. But when you start to analyze it, that's where you typically make it or break it. And if you haven't done the analysis deep enough, it's kind of it's very seldomly that without going thoroughly in the analysis, you would have actually a big market opportunity there out without going to that analytics.
So Andrew is still pressing back on this issue, saying, if I've got traction, I can go to the bank. Why do I need you angel investors?
Well, if you have traction, if you get money, but I think we're now missing the point of that the revenue doesn't come there. So it might be that you have validated with 30 customers paying you $100. There's not that much of money yet. So it's kind of scaling. Why are you needing the money? So we're not talking about that you need to make hundreds of thousands here, but it's more about how to validate, how to make us to be able to agree with your hypothesis. And to make kind of good example of what we did in my first company, so I bootstrapped that one. And when we made basically the first, or when we started to build the product, before we started to build the product, we went and asked for, we first asked for letters of interest. So if you would be doing this, would you buy it? Then we soon realized that people are interested about this. Will they actually buy it? Well, we started to ask pre-orders. So it was simply as that if we do this, are you going to pay us the money? And we had that basically as a paper. Then when we had orders of more, well, we did a kind of high price product, but we had orders for more than 300,000 euros. Then we went to the investors. Okay, are you now actually willing to sum up for this? And we still didn't know that will our product work and can we solve it actually? But at least we proved that if we're able to solve it, there's this type of problem. And we have a hypothesis that the customers are believing, so that proved that there is some traction, but they didn't prove that can we actually do the product. And well, we were lucky and we were able to do it at the end. But one way to kind of create traction around it.
So that's really an effective. I like pre-orders better than letters of intent. But let's look at what, at least in the United States, the banks want to have 3 years worth of data before they'll give you any money. So as a startup, you can't get bank money early usually. Maybe you can get an SBA loan, but that's still not enough. And then when they do give you money, they give you like 1 month worth of your previous 3 months worth of revenue. And so what you need is like 10 times a month worth of revenue so that you can accelerate, as opposed to operational stuff that'll give you a month worth of stuff. So you can't get money from the bank, or you can't get enough money from the bank. So banks usually don't work in the first 2 to 3 years in the United States. I don't know about how it works. I know that in Europe, some of the banks have these early startup funds, but still it looks to me like there's not a lot of money involved in that. And you need typically more to accelerate your growth to get to the proof of product than you can get from a bank, which is why we have this opportunity for angel investors to engage. But there's no point in building the product if there's no customers that want it. And the CB Insights document, they interviewed 115, I think, companies that had gotten angel investing but then failed, and 42% of them failed because the market didn't care about the product. So we would like to eliminate that 42% from our portfolios, which is something we can do by looking for traction. Are there other questions that people have?
I have a question for Tuomas. So Tuomas, you have been creating data and collecting what 70% of all Nordic startup and investor data. So that's a significant amount of what's going on. I wonder if there are any outstanding facts that you have discovered as a result of that maybe you didn't expect or didn't know, or are somehow standing up in terms of as trends in angel investing or trends towards where things are headed, or any other?
Well, I think actually, I think in a high level, it's kind of public already how much kind of angels are putting in capital there, and kind of these bigger numbers. I don't think there's kind of that much interest. But what I actually love is when you go to the granular level. So just to give you a kind of example of a one event that was using our platform to evaluate 300 startups for a pitching competition. And what was fun out of that was that the most used tag for the startup, for 300 startups, the evaluators were tagging that 120 startups had missing go-to-market totally. So there was no mention about go-to-market at all. So already kind of 1/3 of the startups were not kind of getting into that. So the other things that were popping out of this study, for example, was that, well, I think overall what we're seeing is competitive advantage. So that's what we're eventually looking from the pitch decks, that are you finding a solution worth solving and solve it? And if you can solve it, is there basically, do you have a competitive advantage over the other solutions? So it's that kind of, or that's what we're looking at. And that's the thing that very often is missing when we do kind of the analysis of the problem, of the solution on the market and the competition. So I think those are the two things that are all the time popping out from the startup industry, that you don't know how to take it to the market, or then you're missing the go-to-market. You're missing the competitive advantage actually going to the market. So those are kind of two things at least that pops out instantly to my head.
So do you have any significant data from Southern Europe at all? Is there any difference between Northern and Southern Europe that you can express?
Not at the moment, so we're not that expert. So we just started in the spring side of getting this tool up there. So we're actually learning the Nordics and Baltics at the same time, and just getting kind of more and more users in all the time. So learning actually how the data looks like here, but then not that knowledgeable yet on the Southern European market.
Okay, cool. Any other thoughts from anyone? Aaron, you have this worldwide perspective that none of the rest of us have. Have we forgotten something?
No, it's interesting. I just had this conversation here in Germany. There was with the EU stimulus, they're focusing on green technology, and then because of what's happening in Ukraine, also defense technology. So we met with a number of entrepreneurs around Europe that's doing defense technology. And we had meetings yesterday on this, and we talked a little bit about the difference between the U.S. and the European market. I mean, I agree. I don't really disagree with anything that was said earlier. I think from my observation, being an American investor who's invested in Europe, we don't really use the term, or it hasn't been used, about revenue finance, but the reality is that European markets, equity markets, are fragmented. It's fragmented even before Brexit. It's more fragmented post-Brexit. And so in the US, where the IPO is more of a significant option compared to Europe, so that's why revenue takes on more of a precedence when I look at European startups. The comment earlier about there's a small comment, but about meeting with companies remotely, at least in my world, that's starting to disappear. I mean, I'm heading back to California tomorrow. I was talking with a few investors saying, can we get something done remotely? And people said, no, if they want to come and meet with us, for investors, they need to come here into California. TechCrunch, I just got the announcement, TechCrunch is back in person in October. So it's almost like work from home. I think slowly it's dissipating, and I'm seeing the trend now that if companies want to, get investors' money, maybe the first call might be remote. But when it comes to the due diligence, that's going to be back to face-to-face interactions, and so I'm starting to see that go back the way it was. But in the notion of the traction, yeah, I think Thomas and John both said it very well. It depends on traction's defined different ways. For a startup, I'm looking at customers. I mean, it's not revenue per se. All revenue is wonderful. I mean, cash is king. But it is a matter of, do you have customer validation, and do you understand who your ideal customer is? I mean, it's one say to get the early adopters, but if you look at the product diffusion curve, it's that chasm of going from early adopters to mid adopters. I mean, to the mid market, and that takes traction. That's not necessarily financial. So I mean, I'll put it up here. So that those are the things that I think I'm looking at. But I think the notion of exit, how does the investor get their money back for European companies? That's still pretty challenging. certainly compared to the US market. And that leaves a lot of American investors nervous. The institutional investors, not so much, because they're getting yields in some ways from the investment. But for the private investors, it's still becoming a challenge.
So Tuomas, you have 40 investments. What level of return are you expecting to come out of those investments?
Well, it's a good actually question, because now everything looks great because of the valuations went up and a lot of A and B rounds coming out. So and the valuations hasn't gone down yet. So in paper, everything looks good and actually kind of very good at the moment. So because I got into kind of two jackpots completely by luck, to be honest, but still kind of they were bringing well back the whole portfolio and so forth. But how well the rest are going to perform, and I'm expecting now that the paper valuation will not hold up for sure. So it's all about the vintage and how this kind of overall the asset class develops during the next years. Still expecting that it will go higher than the stock index, so that's for sure. But then how much will it be? Kind of 10%, 12%, and the kind of question mark I'm having, is it worth actually the time? That's kind of, well, time will tell that, because it takes still a lot of time to analyze it. So that's the other part of this game, that it's not kind of as easy as you go just buy from your computer at home, go to Robinhood and buy stocks. So that's kind of really simple to do. This requires still more work and effort than that part.
But
anyway,
it doesn't have to, right? You can go to the crowdfunding things and randomly buy random things, right?
Yeah, but the unfortunate part of that we know that crowdfunding, if you index there, you cannot kind of, you most likely lose your money. If you index in stocks, you can go kind of blank and you don't have to actually do that much of work. Of course, you can lose on stocks as well, but they're kind of more secure on going kind of fast in, fast out.
And so angel investing in unregistered stocks that has no due diligence is not angel investing. You have to do the due diligence, because you can't get the indexing on startups with the data that we have. But to answer Andrew's question with some research, the average that we're seeing in the United States from Rob Wiltbank's research is that people are seeing a 3x return on their investment over whatever time period that is. And that ends up being somewhere between 25 and 30% IRR is what the average angel group produces. So
if I could ask a question here, there was a webinar just 2 or 3 hours ago that the Economist Intelligence Unit out of London put together about the energy. I mean, everyone, I think there's a sense of being scared, and so there's a sense of not looking at reality. But in Europe, there is no question, no pun intended, that the coming winter is going to be cold. I mean, the Nord Stream 1, Nord Stream 2 is gone. Nord Stream 1 pipeline is going to be at best 20% capacity. There's going to be an energy crisis at least for the next 12 to 18 months, if not longer. So what's the economic impact, Thomas, or others, that you're anticipating that this is going to have on your portfolio, or on, I mean, we could talk about the economy generally, but we're talking about startups. What kind of risks and headwinds is this going to have on European startups? Thomas?
Well, I think startups and energy, that's kind of depends on your sector, that how that's actually driving the startups overall. So I think a lot of the startups are not impacted, or most of the startups are not impacted by the energy sector, but of course that kind of opens up opportunities. So I have been talking a long time that Germany made kind of intelligent choice when they were kind of shutting down their nuclear plants, mainly for the reason that they kind of as a nation made the decision that they are offering the opportunity to actually create the next source of energy. So without that decision, there wasn't kind of, why do we try to push these startups to create something new? So they create the kind of need for new energy sources. Of course, this whole crisis did kind of surprise, but and kind of went haywire for that strategy. But kind of energy is one of those things that governments can really kind of create the whole market or kind of kill the whole market. And now there's kind of big opportunities to solve short-term energy crisis. Then again, it's kind of knowing that any type of solution, it will take years to develop. So is it kind of a sustainable part to start doing any type of solution at the moment or building a solution? Most likely it's just an opportunity for the ones that has been developing for a longer term solution for this type of situations.
So when energy bills are going to go up, you know, even 4 or 5 times their economists are anticipating, you don't feel that this is going to have a material impact on the startups' finances and their valuation?
I don't believe on that it will take a long time. So I just don't believe on that. So I come from our networks, kind of, for example, we're almost sustaining all our infrastructure at the moment. And actually, we have somewhat high prices here, but then again, we do have reserves that are not used at the moment. So in practice, by a decision, we could be in the same situation that we were before the Russian sanctions came in. So I'm kind of, how long this will take, how slow the machine will be, but I'm more seeing this as the slowness of a machine than instead of kind of a long-term issue, and just that we will fix it up. But of course, it has short-term impacts, which are, I don't want to try. So can or answer that question and have their take. But from my side, thanks very much for everybody for the discussions. And John, last week, very much a big thanks for inviting me here. Been a pleasure.
Thank you, Tuomas. And I'm aware that you have to leave and you have already stayed 5 minutes more than your time allowed you. So thank you so much for being here, and I hope to see you in Finland. Thank you. We'll stay here to continue for a few more minutes.
Yeah, thank you. So I see a question from Luciano that asks for a minimum number of companies to acquire in the first few years. I would argue that you want to be investing, have a diverse portfolio over time. And so somewhere in the, you know, if your goal is to get to 20 or 40 and you're going to spread that over 5 to 6 years, that'll sort of set it. You know, I think the Oregon Angel Fund model of doing 5 or 6 a year is quite a reasonable pace. I know some micro VCs are doing 10 a year. I think that's a professional level pace. It's not unreasonable from an investor, starting angel investor point of view, to do 2 to 4 in the beginning each year, and then work your way up to 5 or so a year. It's better to go smaller and to go slower at the beginning so that you get perspective and knowledge before you jump in and burn a lot of money on mistakes. And then I think it's good to start with industries you understand. And so that's a good starting point, but that's not sufficient. If you only invest in med tech and you're only very narrow, then when that market goes nuts, then your portfolio goes nuts. And so diversity in the broader sense, having a few different things makes some level of difference. We're coming up on our end time. I would like to give Astrid a little bit of time to talk about our program.
Thanks a lot, John, and thanks everyone for being here. I'll quickly introduce what we are doing because we have an exciting thing coming up. As some of you may know, we run Angel Investor Learning by Doing program. And parallel to that, we also run startup competition where startups apply for funding and they compete for winning the competition. To participate, you'll need to be an early stage startup and below 10 million valuation. The startup deadline, application deadline is September 7th. So I'll urge you, if you know anyone that is looking for angel investing, just let them know about the competition. All startups are welcome, regardless of their geographical location. And if you know any investors that are looking for building their angel investor skills, you may know that we have an angel investor learning by doing program, which trains angel investors in groups and helps them build their ability, their knowledge, and their from personal investment thesis up to making a post-investment procedures. So if you know anyone in the field, let us know or let them know about us. Thank you. I guess that's all. Thanks everyone for being here. I'm aware that John has further commitments for the day. John, you have some final notes, and we can end it here.
Well, you have another meeting coming up next week. What is that?
So we have actually several events coming up, both for startups and for investors. We have an upcoming event dedicated to startup finances. A lot of times startups, when they just start, their finances are fuzzy, as John would say. And so it takes kind of polishing and forming them before they'll be investor conversation ready. So we are hosting a workshop about the topic where startups will learn how to turn their finances into presentable mode and how to think about them in general. And we have another event coming up next week that is dedicated to due diligence. Due diligence is the process that investors follow before making a decision whether or not to invest. The event is suitable also for startups to join to understand how investors think and what are the things they pay attention on, how the due diligence process is done. So we have both events, and we have another event coming up that is an information session about our program. I believe John just shared our link, so if you just follow that or share it with your network, that'll be tremendous help to us, and we hope you'll be able to join them.
Yeah, thank you so much. So on the bottom of your chat, there should be 3 little dots. If you click on that, you can save all of the chat, and there's some useful things in there. Thank you for coming. Glad to be helpful if you have a startup journey or an angel journey. Thanks everyone for coming.